What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is January 7th of 2020. Well, folks, I hope you are having a fantastic day wherever you are, and in today's video, I want to spend some time to talk about the three key elements that I believe are not only going to lead Bitcoin to all-time highs going into the next few years, but along with that as well, what's going to lead it to becoming a multi-trillion-dollar asset. So we've got a lot of interesting data and topics to talk about, but first off, to let you all know, this video is sponsored by eToro. Now, for those of you who may not know, eToro is a social trading platform that allows you to trade alongside other traders in the cryptocurrency market. And what's really great about it is they recently launched their copy trader feature. So you can get real-time stats on individual traders. You can get their portfolio holdings, a chart of the performance over time. But along with that as well, with a click of the blue copy trader button, you can trade alongside them real time at the exact same price. So if you guys are interested, check out the link down below in the description. All right, so let's go ahead and talk about the current state of the market here, guys, because markets have been heating up here over the last 2 or 3 days. We've not only seen Bitcoin doing quite well over the last few hours, but we also have a ton of players across the board in the green here, with very few players down in the red at the moment for cryptocurrencies. And not to mention as well, we've got some of our top plays up here. We've got Chainlink and Ren playing some of the leading market players here, up around nearly 9%. It's even had a little bit of a pullback here over the past hour or so. Ren doing nice as well, around 7%. We also got some long-term plays like IOTA and Horizon that have come back as well. Now, right now, Bitcoin has regained a lot of dominance, as we'll talk about in a moment, but I don't want to get too far off track. The major thing here is that Bitcoin is coming back quite strong here. We were down just a few weeks ago, tailing around 6,500, and now we're well up over $1,300 here, trading at $7,800 for Bitcoin. If we take a look here on the weekly, we can see all of our indicators are flashing here. We've got the squeeze momentum indicator setting 4 higher weeks here in a row. We've got the divergence in the MACD declining, getting very close to a cross here. So if we had another positive week or so, we'd probably get the cross. And we also have the stochastic RSI, both lines in the purple channel, heading up higher. So the weekly looks great. 4 out of 5 points out of our 3 indicators are flashing, meaning that we have a buy signal on our side personally. I'm not telling you guys to do anything. It's just for me. This always gives me a good little edge of confidence in this case before I actually make these trades. And the key thing to take into mind here is really taking a look at the longer term chart here, right? We'll go ahead and take a look at BLX, right? Get a look here on the longer term chart. We'll take it over to the log chart so our lines match up. But you can see here, the long time line of support here is right where price is coming in, right? So again, we might push sideways here, but again, we might start ticking up a little bit earlier. Back here, if you take a look at the previous cycle, though we did have a big wicks drop here in price. I'll go ahead and zoom in on it so you guys can see it and turn off our indicators. You can see here, we did get this, we got contact, but the whole thing about it was that it was a very quick flash sale price. So I would kind of discount it in the sense of price action and see how we never actually came back down to test that line of support outside of that event. So I wouldn't be surprised that we don't get that, if we don't get that and actually just continue higher, right? Now, I want to go ahead and dive into the substance of this episode, right? Obviously, markets are looking good right now. Altcoins are doing quite nice as well if you're in the certain place that we're in right now. I want to go ahead and talk about this question of what's really going to lead Bitcoin to go up in the next cycle, because I always like to view things in a very simple but big picture way, because this is where we really have to focus as a macro trader in this case. If you guys consider yourselves macro traders like myself, who want to get a big picture view and really think about what are the next big cycles to focus on where we can make multiples on our money in this case. That's really the question at the end of the day. Well, obviously it's cryptocurrency markets in my view, but what's going to fuel cryptocurrencies from becoming the current $200 billion, $210 billion market that it's at now to a multi-trillion-dollar market? That's a very big claim to make. To say that this small market, this niche market that still is relatively unknown by most of the world, is going to become a multi-trillion-dollar asset class that almost everyone has some exposure to. Well, there's a few reasons for it, and I want to go ahead and talk about those, okay? So the first one here is the negative yielding bond market. Now, we've already talked about this a decent amount, and I'll actually kind of run through this quite quickly. But for those who don't know, it's basically a market of government bonds, in this case, or in the United States, what would be known as treasuries, that have a negative yield. Now, luckily, the United States has not dealt with this, but a lot of countries have, from countries in the EU to other countries as well, like Japan, that was really the kind of poster child of this issue. Luckily, we actually have seen a decline here in negative yielding bonds, because really in the real world, there shouldn't be negative yielding bonds. It doesn't make sense. It's basically people giving their cash in the form of a IOU that they're losing money on. That doesn't make sense. But it has been persistent because the problem is that pension fund managers manage this kind of stuff, and they are mandated to hold some of these assets. Well, over time, there has been some decline in exposure, not to mention some of the yields on these bonds have now started to actually turn into the positive region. They're not great, but they're at least positive. So we've now started to see people as well, I think, moving capital out. We've seen this in gold markets. We've seen it in silver markets. People are finally starting to look for alternative hedges. Even though they're not providing a yield, they're not losing money. And they're also providing hedges against the instability and the fear in traditional markets. And speaking about traditional markets, we have to talk about equity markets, right? The multi-trillion-dollar asset class, especially U.S. equities, that have ballooned over the last decade to the largest expansion and the longest expansion in economic history. Well, there's an interesting element we need to talk about here. Not only is there the overexposure here in the S&P 500 to a few select companies, so the vast majority of the market capitalization in the S&P 500 is in the top 5 firms, right? And this is going to likely make up a lot of the FANG stocks that we've talked about. Facebook, Amazon, Netflix, Google. You're talking about a lot of these big tech companies that are starting to dominate a lot of the exposure to the highest level we've ever seen the top 5 go to, even back during the dot-com era, back here in 2000. So this tells us that we're betting on a few key players here that are really driving the earnings of the S&P 500, that are bringing the excitement and the confidence we have and the valuations that we've given to the S&P 500. I don't want to talk about just so much this. This isn't my real concern here. My concern is S&P 500 earnings over time, right? I want to know if the S&P 500 is going to be able to continue to sustain itself. Well, because we all know at the end of the day, what has been driving these markets, what's been leading these valuations is corporate earnings. It is one of the few fundamental factors that really actually is driving markets, because we've had massive tax cuts in the United States, not to mention as well, the economy is towards the later stage of its cycle, so earnings tend to be higher, generally speaking. The economy has relatively low unemployment comparative to the last decade, and we have corporate earnings shining as consumer spending and confidence go up. Not to mention, you combine that with the tax cut, deregulation, you get a pretty good cocktail for short-term success. Well, we can see here that stock buybacks have started to decline. Dividends are charging forward. These are really, however, though, the two things that have kept equities up. Because on an annual basis, if you have nearly over $1 trillion, if you add dividends here, about $500 billion annualized, and you have stock buybacks here around $700 billion, you're talking about $1.2 trillion of guaranteed buy-side activity coming on in equities, because people usually do what's known as dividend reinvestment programs or DRIP programs, where they get paid dividends, they buy back more of the shares of the company automatically through their exchanges. Not everyone's doing that. A good amount of people are. Not to mention as well, you have here stock buybacks. So companies just literally buying up shares off the market, increasing their earnings per share. So it's a cyclical process in this case. And also we have the Fed balance sheet coming in, but this isn't really what I want to focus on. The thing I want to talk about here is understanding that corporate earnings are the driving force for equities, because it's leading to companies using some of that profit to buy back their own shares or pay out larger dividends to investors that are usually going to reinvest it. This means corporate earnings is the key driver. If corporate earnings drop, we are likely going to see, at least if it's in a significant manner and doesn't reverse quickly back to the upside, we are going to see equities start to decline. And that is exactly what history shows us. This is a beautiful chart. A beautiful tweet here that was posted by Samantha Leduc, I hope I'm pronouncing your name right, who runs one of her own firms. And you can see here that historically speaking, from the last two tops, when we got a significant decline in corporate earnings, this was a great precursor to understanding when markets were going to decline. Right? Now, we have seen the first decline since back here in 2015, when we entered into, I would say, almost a minor recession, where markets were concerned that we were at the peak for this equity cycle. I remember trading back then. We had a flash crash in the summer of 2015 of around 10% in one day. It's a pretty scary time, and you can see that being reflected here in equities, right? So that we have the chart down here of the actual S&P 500 alongside corporate earnings, and you can see just how well it lines up here when you start to see the first significant drop here in corporate earnings. and we're now rallying to all-time highs in the S&P 500. We have been over-diluted with buy-side pressure from stocks and drip programs rather than real-world investors, rather than new money really coming in. It's companies using the cash on their balance sheet that they should be using for the real-world economy, but they're sadly just investing it into the equities because as shareholders, that's their incentive. Their incentive is to use cash on the books. Well, when you stop investing that in the real-world economy and you start putting it into an artificial market, eventually corporate earnings start to die off because money isn't circulating in the economy anymore. The funny money runs out eventually, right? So, because of that, if corporate earnings start to decline significantly, if we get anywhere from a 5 to 10% drop in quarterly earnings, that's the sign. That's the warning sign that it's time. Time is coming around the corner here where we are going to finally start seeing reversal in equities and eventually lead into a recession. All right, so this is my second point here to Bitcoin, right? You need inflows into these markets. You need money to move out of markets where people, in the case of negative yielding bonds, are not getting a yield. You need to move into a market like Bitcoin when you start to see massive outflows coming out of equities, right? These are multi-trillion-dollar markets we're talking about. And if you even just get a pinch, a small amount, 5 or 10% of the liquidity from these markets, you can make Bitcoin a trillion-dollar market easily. I'm confident in that because in the last cycle, we only really had anywhere from about $50 to $100 billion in real inputs into crypto markets between the beginning of 2017 to the end of 2017, where we had Bitcoin going from 1,000 to 20,000. It's not too difficult to get Bitcoin to go from where it is now at 7,700 to 100K, which is our target for this next cycle. Now, the third thing here as well. What's the third element here? Well, you've obviously got I wouldn't say guaranteed, likely outflows of these markets becoming inflows to cryptocurrency markets. But the third one here is also what drove a lot of the last cycle: speculation, anticipation for new technology, and simply those who are trading new financial markets. All right, it's kind of a bundle of a few different things. It's kind of a miscellaneous third category, but it's the things that usually drive kind of the early stage market cycles. People who are aiming to catch the new trend, people who are investing in a new market, a new asset class. When we're talking about a $200 billion market cap for all of crypto, it's not too crazy to think that there is going to be a good amount of capital simply investing because this is a new asset class, right? Outside of the fact of the other two markets where money is just simply entering in because it's looking for a safe haven, right? There's a lot of reasons for Bitcoin to go up that meet into this category. A lot of people hedging currency inflation. Just for example, this past week, I've been hearing stories that we're seeing record amounts of volume on exchanges like local Bitcoins, a lot of the peer-to-peer exchanges of money or local currency, like Argentinian pesos and Venezuelan bolivar exchanging into Bitcoin, the largest amount of volume we have seen yet. So you have all these people hedging currency inflation. You have the institutional side where money's getting out of bonds that are negative yielding. You also have, of course, equity markets that might start to see a decline in yield, so therefore capital will move out. All these elements coming together that really paint the picture. And when you take a look at the longer term picture, it becomes clear that we're setting up for this next cycle, guys. If you take a look at any of the data science models, we came back down to the historical support around 0.6 or 0.8 on the Puell Multiple that takes in the daily issuance of new Bitcoin versus the 365-day moving average. This is exactly what happens every time after we revisit back here to the low here, starting the new cycle, or the bottom starting off the new cycle. Low did as well. 2-year multiplier, right? If we take a look back here, the bottom we had here for the correction before we continued on to the cycle back here in January of 2016 was a slight decline below the 2-year multiplier, ERME multiplier, right? And now we can see that's exactly what we did over here. We went below it for a couple of weeks, came back above, and then we're going to continue most likely higher. Take a look at the MVRV Z-Score, right? This is taking market cap minus realized cap over the standard deviation of market cap. We can see here that we had a pretty stark decline. We're actually quite cheap from where we should be right now compared to history, where we actually held a little bit higher. And I think this has to do with the fact that we had one of the most overextended rallies that compared to the past year. We went up here to 2.6. But we're actually cheap compared to where we should be in the sense of the cycle. And last but not least, in the sense of data science models, and then we'll take a look at a very relevant model that I think everyone needs to see. Right here, the stock flow model. Looks like we're finally curving back up here. If we zoom in, we can see that we're setting higher levels on the stock to flow and anticipation for the May 2020 halving for Bitcoin. And to put it all in summary, nearly 90%, we're at 89.4%, nearly 90% of all of Bitcoin's history, if you've bought Bitcoin, you're at either break even or up on your money. There's not many assets with the kind of volatile run-ups that Bitcoin has, the kind of potential for return, the risk to reward profile that you get with Bitcoin that has this kind of also historic profitability. This to me is very exciting. I'm very excited to see where Bitcoin is going to go over 2020 and over 2021. There's so many fundamental elements, not only the emergence of Bitcoin and other cryptocurrencies as hedges and as stores of value with their fixed monetary policy, whether some of them be deflationary or declining in inflation, or ones that may have inflation rates that are at least predictable. But along with that, the elements of what's going on Ethereum and other blockchain networks and the DeFi ecosystem of decentralized finance. They're building such amazing applications. There's so much to look forward to over the coming year, guys, and I'm very excited to be in this journey with you. So if you're excited for it too, drop a like. If you like the video, guys, please leave a comment. Engage with one another in the comments. If people have questions, try to help them out and explain, any questions someone might have in this market. I think crypto is set up for a really exciting year going ahead, and I want to let you all know that I'm going to be right here with you all in the process. All right. Anyways, that's going to be it for today's video, guys. I hope you all enjoyed this kind of macro perspective video with all the data that we went through. But until the next one, I'll see you all in the next video. Stay tuned.